We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell.
Today, we continue with the second episode in a multi-part sponsored series with Delaware Life. I'm happy to introduce our guests, Brendan Payne and Jeng Chiu, both Vice Presidents of National Sales Consulting at Delaware Life. So welcome to the podcast, Brendan and Jeng.
Thank you.
Hi, Bob. Great to have you here. For the benefit of our listeners who may not be familiar with you and your work, do you mind, Brendan, we'll start with you, if you give us a brief overview?
Absolutely. My name is Brendan Payne. I am a Vice President with the National Sales Consulting team at Delaware Life. The National Sales Consulting team is basically the advanced strategies team of Delaware Life. So we're in benefit to the advisors we work with in one of two ways. First, proactively, by providing them with novel business building ideas on some advanced concepts. And second, reactively, we're always available to consult and assist with any sort of complex, high net worth, unusual cases that come across their desk. I have an LLM in taxation, been in the annuity industry for about a decade. And my areas of expertise are really in estate planning, tax mitigation, working with trusts, selling a business, IRA rules, those type of things.
Great. Jeng?
All right, my name is Jeng Chiu, and I work with Brendan. I'm also Vice President of National Sales Consulting. I am based in Avon, Connecticut, which is a town outside of Hartford. I've been in the business since about 1998. I started out doing fee-based financial planning, and then I've been in various roles in national accounts and also advanced planning as well.
Great. So this is the second of a multi-part series that we're doing with Delaware. Today, our topic is taxes. And my first question is, why do advisors need to think about taxes in retirement? And how do at least some advisors differentiate themselves without providing tax advice?
Well, taxes are going to be, for the vast majority of clients, their biggest expense throughout their life, in both the accumulation and the distribution phase. And taxes do not end in retirement. For the vast majority of clients, they're going to be drawing income and money from qualified accounts, whether it's IRAs, 401ks, 403bs. Those are all taxable income to the clients. And in addition to that, the vast majority of retirees are also going to have at least a portion of their Social Security subject to taxation as well. So managing taxation in the accumulation phase, that's pretty obvious. We want to pay as low a tax as we can while being able to save as much as we can for retirement. But it's equally as important in the distribution phase, as taxation generally will be lesser, or income, and therefore taxation will generally be lower in the distribution phase, but it's still critical to manage that. And there are a couple strategies that are available to try to manage taxation in the distribution phase, and one of them being something known as sophisticated bracket management. And that's where clients and advisors can help clients to draw assets from taxable buckets, tax deferred buckets, and tax-free buckets, whether that's from IRAs and non-qualified assets and Roth accounts and life insurance accounts. Draw those down in a manner that limits taxation as much as possible.
Right. So I want to talk more about taxes in distribution, but first, let's talk a little bit more about the current environment that we're in. We're now looking at a world in which there are potential and actual tax changes taking place. What do advisors need to know about the current environment?
Well, I'll mention this one, Bob. It's I think the most important thing is we don't know what's going to happen as of now, but I think it's important to have a contingency plan. And I think that's the most important thing that advisors could bring value, because as we know, taxes could change, and there's a lot of provisions that might end in 2025. might go in 2026. There's some talk about some different IRA caps on high net worth individuals. So it's important to always keep up to date on taxes. I think as Brendan mentioned earlier, a lot of advisors don't really focus on taxes, but if you think about it, if you are retired, you're essentially unemployed. And if you retire at 50, you could be unemployed for 30, 40 years. So anything that advisors could help save money on taxes, they're not bringing income. All their income is coming from investments, interest, but taxes could be a big part of it. And anything that advisors could do to help minimize some of those expenses, then they obviously, probably want to look and investigate that. I also mentioned one other thing. I know we talk about taxes, and there's always a sort of this gray line of, is it tax advice, as you mentioned earlier, versus tax strategies? And if you think about a lot of things financial planning wise, it does, a lot of tax strategies have to occur, right? Because whether somebody takes a traditional IRA versus a Roth IRA, it obviously involves taxes to some degree, but of course we don't give any tax advice. So I would say in this tax environment, it's as the government is trying to raise revenue, taxes will be one of the most key components on how the government raises revenue to pay for some of the expenditures they're looking at. So it would be wise for advisors, even if they don't focus on taxes, to understand what the taxes and how they might impact their high net worth clients.
Mm.
And to build on that, Jeng, it's interesting that we're in such an uncertain time right now, but there is actually a little bit of certainty. In fact, in 2020, if Congress takes no action by the end of the year or next year, in 2025, many of the provisions of the Tax Cuts and Jobs Act of 2017 are going to sunset. So we're going to see by default an increase in some of the tax rates. We're going to see by default a reduction in the estate tax exemption. So some of these things are going to revert to more onerous tax regimes within the next 4 years if Congress and the legislature does nothing. And actually, I was speaking with an advisor early in September, when things were a little more in flux. And we were speaking particularly about the estate tax exemption, and it currently sits at $11.7 million. And he asked, if that goes down to 5 million, or that goes down to 3.5 million, what sorts of strategies, what sort of new strategies do you think are going to come up and come into play? And I thought that was a very interesting question. And I said, there's not going to be any new strategies. What you'll see is some of the greatest hits starting to get replayed. So things like credit shelter trust, bypass trust, AB trust, ILITs, those are going to come back into play. And a lot of advisors probably haven't had a client walk into their office in the last decade with a brand new bypass trust or a brand new ILIT, but they probably have those on their book of business from clients who created them 12, 15, 20 years ago. So it's going to be important to get reacquainted with those type of strategies and talk about the financial instruments that can be used inside of those strategies that are most tax efficient for clients.
My guess too is that until some of these changes actually take place, it's not necessarily wise to take action in advance of those changes, because they may or may not, well, in the case of the sunsets, they'll happen potentially. But in some cases, folks earlier this year, for instance, we were talking about the capital gains tax being retroactive to September. And for folks who may have accelerated taking capital gains, that may not have proved to be the wisest decision.
Well, it's important to be thinking about it. It's important to be prepared for any changes that come. There are some pretty wild proposals out there about things like taxing unrealized gains, mark to market on unrealized assets inside of trusts, things that could really hammer high net worth people, and defining high net worth people as people with probably more than $10 million in assets and earning more than $1 million a year. Those are really where some of these provisions and some of these new tax regimes can really hurt some people. So those would, and it's, who knows the likelihood of whether those go into effect or not, but those could completely change tax planning as we know it for high net worth individuals.
And in some ways, Brandon, I think you've just highlighted how and why it's so important for advisors to differentiate themselves around being knowledgeable about taxes, both actual and potential changes.
Certainly. As we said at the top, taxes are the number one fee that clients are going to deal with. So advisors need to be knowledgeable on taxes, and they need to build relationships with CPAs, with tax advisors to, one, bounce these type of questions off of, and two, help build their professional networks to be able to refer clients back and forth.
Yeah. So let me turn my attention to something that you mentioned a second ago, taxes during the accumulation phase in retirement. There's a laundry list of things that advisors can be doing. Chief among them is looking for assets and opportunities within a 1040 form. Talk about that.
Yeah, I'll mention that as well, Bob. One of the things that you want to take a look at, whether they're working with clients or you're looking at prospects, the first thing I used to do a lot of fee-based planning when I started out my career. And if you're meeting a prospect for the first time and you're able to get their tax return, I would zero in on that tax return if possible, because the tax return will obviously tell you how much income the prospect or client might have, but then it'll also tell you what type of investor they are, what they're invested in, where they're invested in, how much cash they have. And you could take a look at all the different aspects of the 1040. And a couple of things I'll just mention real quick. We don't have a 1040 in front of us, but I'll mention a couple of things real quick. Is that you want to look at a couple of things, especially, for example, their cash position and their interest. If somebody has $500 in interest, you might think, well, that's not very much interest. But think of, in this low interest rate environment, how much money, how much principal do you need to generate $500 of interest? You need about $100,000. Right? Because it's 0.5%. It's literally what you're getting on a CD. You're getting 0.5%. So even as something as innocuous as $500 interest on the 1040, when you look at the line item on the 1040, it means that they probably have a lot of excess cash. If they have $1,000, they probably have $200,000 in excess cash. So the real question is, why do they have so much cash? And that's how you find that information. The other thing, couple of other things that we kind of look at on the 1040 is their dividends. Now, a lot of people think dividends are tax advantage, but only qualified dividends are tax advantage. You know, ordinary dividends are not tax advantage. You pay at the highest dividend rate. And if you're in the accumulation phase and you have earned income, you probably want to minimize any unnecessary taxes. When I used to work with clients, they always tell me that they hate paying taxes, but the thing they hated more than paying taxes is paying taxes on income they didn't need. And if you're earning income, you don't need to pay taxes on some of those dividends. And if you have over $1,500 in interest and dividends, a combination, then you fill out what's known as a Schedule B. And the interesting thing about Schedule B is that the client has to list out exactly where that interest is coming from, how much interest they get, how much dividends they get, and where they derive those dividends from. So it's a good way to see exactly where they have their money. So maybe they have some of their assets with you and somebody else. If they have a lot of dividends and interest, you know where they're going to be banking, you know where they're deriving their dividends from. You have to actually list out the institution where they get that. So it's a good opportunity for you to understand what type of investments they have, if they're conservative, if they're value oriented, if they have a lot of short-term capital gains on the 1040, you could see that they might be more active in trading, or they're investing more aggressive stocks or mutual funds or other types of investments, maybe growth oriented. So it's interesting that even if they don't talk to you about if it's a prospect, just by looking at their 1040, you could kind of get a good idea of how they're invested and what type of investor they are, and start your conversation that way. So when I used to look at fact finding and trying to understand what the clients, what their investment positions are and how they felt about different investments, I would look at the 1040, because that's your gateway to understanding how the clients feel and the factual aspects of how they're invested and what they're taxed on.
Yeah, it strikes me that the 1040 is just chock full of opportunities. If someone has a Schedule C, but maybe hasn't made any retirement contributions, there's probably an opportunity for a SEP or a solo 401k and whatnot, right? If there is some net profit from the business.
Yep.
All sorts of things. So talk about how one might go about identifying and then perhaps avoiding some of the hidden tax traps when you're in the accumulation phase.
There's several different hidden tax traps, and they all revolve around taxable investments in taxable accounts, really. The first one, and probably the one that sneaks up on people the most, is embedded capital gains inside of a mutual fund. So most actively traded mutual funds, they have a manager, they're buying and selling securities in the mutual fund throughout the year. And at the end of the year, around Thanksgiving time, is when mutual fund shareholders receive notification whether there's any embedded capital gains inside of that mutual fund, and whether they will be responsible for paying the tax on those embedded capital gains. So that's an important thing to consider when a client is purchasing a mutual fund, particularly if they're going to be purchasing it in the latter half of the year, because they could be stuck with embedded capital gains that they did not participate in, that happened maybe in the first half of the year, and now they're buying it the mutual fund in October, and they're going to be the one with that tax bill. And this goes hand in hand with turnover ratio. So more likely the mutual funds that have higher turnover ratios, north of 100%, some even north of 200%, are going to be more susceptible to these embedded capital gains. And this is something that you can check out on just about any mutual fund's Morningstar page, for example. There's a tab on Morningstar called Tax. And if you click on that tab, I believe at the bottom of that page, it says TCGE. And that will tell you what the embedded capital gains are in that fund for that year. If there's a positive number, then there is embedded capital gain. So that's an easy way to check out what is in there. And then finally, something that I think gets overlooked by a lot of investors is the net investment income surtax, the 3.8% surtax for the Affordable Care Act. That's been in place now well over a decade, still exists, was not removed when the Affordable Care Act was overhauled several years ago. And this adds an additional 3.8% surtax on all investors who are on capital gains who are earning more than 200,000 single or 250,000 married filing jointly. So this is going to capture a lot of our clients, the clients that we're working in. And these numbers are not indexed for inflation. So these were the thresholds that were set, I believe, in 2009. They have not been indexed for inflation. So they're going to capture more and more clients each and every year.
A much talked about topic is Roth conversions and the potential taxes that those create for account owners, taxpayers.
Yeah, I take a look at Roth conversions as something that is mentioned, especially when we look at the environment of potential higher income taxes going forward to pay for some of these spending bills. And a lot of times people think Roth conversions, a lot of advisors think Roth conversions, and the conversations with clients are about whether they want to pay taxes now or pay taxes later. Sometimes they focus on the required minimum distribution aspect of it. Sometimes they focus on the legacy aspect of it. But there's a couple of things that many advisors probably want to think about is whether they should do Roth conversions. And a couple of factors might be whether one factor a lot of people overlook is state income taxes. Because a lot of people think about federal income taxes and what they pay if they convert from a traditional IRA to a Roth IRA. And a lot of people overlook the state aspect of it. So for example, let's say you're 55 years old and you've accumulated $10 million or 10 million, whatever it might be. And you think, well, I'm in a high tax bracket. I'm going to be in a high tax bracket for a long time, but you want to move to Texas, which is actually quite common. So a lot of people say, okay, I don't want to pay the 13% as California state income tax. I want to go to Texas and there's no state income tax in Texas. So you see a lot of that. Well, if you convert while you live in California, now you're paying an extra 13% on that Roth conversion, which you may otherwise have not. And this is also factors, for example, of some people who might live in New Jersey or New York, where they also have high state income tax and they move down to Florida. And so, the timing of when people do Roth conversions actually matter a lot, even in their working years, when they should do. The other thing advisors might want to think about is what I call gap years. So what's a gap year? So let's say you retire at 60, but you haven't started taking Social Security. You're not factoring Medicare for a couple of years. You no longer have earned income. So let's say you had 500,000 earned income. You were at a very high tax bracket. So if you convert then you're going to be, all that money is going to be taxed at your highest rate. So a gap year is when you retire and don't have any earned income yet, but you're in the lowest brackets because you don't have earned income. And that might be something where you might want to think about doing a Roth conversion in those years, because then you start off at zero. So you capture all the lowest brackets when you do the Roth conversion. So look for those gap years, especially for your sort of higher income earners, higher net worth folks who haven't started taking Social Security yet. And also, one thing that a lot of people overlook is that if you're 63 years old and you do a Roth conversion, then that might make your part of your Medicare premiums higher. And a lot of people don't understand that part of your Medicare premiums, the factor is that the coverage is the same. The only difference is how much premiums you pay. And they look at the tax returns. And if you're 65, they'll look at essentially your tax returns when you're 63. Essentially, that's what it is, because that's sort of the way that they view it. And so if you convert at the wrong time, right before you take Medicare, then you might end up paying higher premiums for Medicare. So those are a lot of things that people don't think about when they look at Roth conversions, but things that they should consider at least when evaluating. And don't forget, Roth conversions are not all or nothing, because you could do small portions of Roth conversions per year as well. And we also know that if you capture the lowest brackets, then one strategy might be you just convert until you hit the 15%. Or some of the lower tax brackets as well. So just kind of a couple of things to think about when people are considering Roth conversions that they might have overlooked.
Yeah. There's also been a lot of discussion lately about both the mega and the regular backdoor Roth. Any thoughts about those types of conversions?
Yeah, certainly. The backdoor Roth conversion is a tried and true strategy that a lot of high net worth or high earners have utilized. So we all know that to make a direct Roth contribution, there are very strict AGI limitations, and you cannot make any sort of direct Roth contribution above those limitations. However, high net worth individuals or high earners would like to be able to put money into a Roth, so they can use this backdoor strategy. Now, there's a couple hiccups to it. One is you have to make sure there are no other traditional IRA assets, because any sort of conversion from a traditional to a Roth takes into account both non-deductible and deductible contributions on a pro rata basis. And anyone can make a traditional Roth or traditional IRA contribution. It's just a matter of whether it's deductible or non-deductible. So these high earners can certainly make a non-deductible contribution to their traditional IRA. And then as long as they have no other deductible traditional IRA assets, they can convert that non-deductible amount to immediately to a Roth. And there's no taxation on that because there was no deduction to begin with. The other hurdle to that is you can only convert $6,000 or $7,000 per year. So it's a relatively low amount, particularly for these high earning individuals who probably want to get more into a Roth. And that's where the strategy known as the mega backdoor Roth conversion comes in. And this is where an individual utilizes a 401k or a qualified plan to make this conversion. So inside of a qualified plan, an individual can have up to $58,000 in total contributions from all sources each year. So that includes salary deferrals, company matches or profit sharings, and forfeitures from other plan participants who leave the plan prior to being fully vested. And whatever those amounts add up to, that's their pre-tax, that's their pre-tax amount that goes into the qualified plan. Now, if the qualified plan allows for after-tax contributions, and some plan rules allow for it, some plan rules don't, the individual can contribute the difference between their pre-tax contributions and that $58,000. That can be added in as an after-tax contribution. And then from there, if the plan allows for it, the individual can roll over that after-tax amount each year directly into a Roth IRA. There's a IRS notice that was issued about 7-8 years ago that allows for that bifurcation. So this is a way to potentially get $20,000, $25,000, $30,000 per year rolled over directly out of a qualified plan into a Roth IRA. That's certainly more than $6,000 or $7,000 per year. You can see how quickly that could add up over a number of years. And for advisors, it's a way to get those assets out of your client's qualified plan and onto your book of business before the traditional times we can usually do that, either at retirement or when they switch jobs. So for our clients who are in their high earning years, which is usually in their 40s and 50s and 60s, they're still significantly far off from normal retirement age. This is a way to start getting those assets onto our book of business and getting it into a wider investment arena. As we know, most qualified plans have limited options, maybe several dozen different investment options. Obviously, inside of a Roth IRA, we're open up to the world of mutual funds, securities, annuities, all of those different types of options.
Jeng, anything to add to that?
No, I think Brendan covered it. I think there's a lot of one thing that people want to start looking at is some of the legislative proposals to stop mega backdoor Roth IRAs, right? So that's one of the things that the House, and just seems to be, 1 week it's in, 1 week it's not. So people will have to kind of evaluate that based on the, if it happens within the next month or so, whether some of those strategies will survive. And there's different timelines. Some will end in December 2021. Some will not begin until 2028 for some of the R&D requirements and some of those large IRAs. So something to keep in mind is that a lot of these strategies also may have a legislative time limit as well that people want to consider. So it's very important. Sort of the theme of the story today is that with some of the watershed legislative, potential legislative actions, that the flip side to some of those spending bills will be how do they raise revenue, and some of these large IRAs that they're targeting in terms of distributions, forced distributions, stopping mega backdoor Roth IRAs potentially. So something to keep in mind. Great strategies, as Brendan outlined, while they still exist. And so if you have clients who are interested in that, you probably want to keep close tabs on what might happen.
So let's turn our attention back to taxes in the distribution phase. We talked a bit about tax efficient withdrawal strategies. Part of those strategies, I think, require that the advisor think about account location and perhaps creating what I'll describe as tax equilibrium. Care to comment on that?
Sure. The traditional sort of thought pattern might be, most people have most of their money in tax deferred, right? The majority of their retirement savings is tax deferred. 401ks, traditional IRAs typically, they typically don't have, they have some money in fully taxed. For example, if they have some savings accounts, CDs, they might be part of that might be in fully taxable. Where they usually don't have a lot of money is in tax-free, because it's very difficult to get tax-free. So Roth conversions, once again, comes into play. Potentially some cash value in life insurance, if they have some of that, could be tax-free. So the importance of having sort of a diversified tax portfolio, a lot of people focus on asset allocation, diversified investment portfolio, but the benefit of having a tax deferred or tax diversified portfolio is that as tax law changes, you can make adjustments. So for example, if you know that you're going to be, for example, in the gap year, then you might want to sell some capital gain assets if you're in the lowest bracket, because capital gains and the lowest bracket is actually zero, at least under current law. If you think taxes are going to go up, then you might have a different strategy. You might want to save some of those capital gain type assets for the future and take more money out of tax deferred assets if you think that your assets will continue to grow and you might face some rising income tax strategies or income tax provisions later. So the key is to have different types of assets and different types of taxable assets so that you can make adjustments to your portfolio as you go along. And one thing that you always want to do too is you want to try to, in the accumulation phase, as we mentioned earlier, to defer some of those taxes as long as possible, because while they're earning income, you're probably going to be in the highest tax brackets.
Brendan, anything to add to that topic?
Jeng covered it. It's critically important to be looking at asset location, asset allocation, and making sure we can save our clients quite a bit if we set up their taxes and their distribution strategy correctly.
So let's turn our attention then to the tax impact on legacy planning.
All right. I'll mention something that a lot of advisors often overlook for tax planning, particular regard to income taxes. A lot of people think of their beneficiaries, and beneficiary planning is a big part of financial planning in general, but also income planning as income tax planning as well. So, for example, a lot of times people put their spouse when they first start a job, they'll put their spouse as their primary beneficiary. And if something happens to them, then their spouse takes over their accounts. But then a lot of times they don't think about the contingent beneficiary. And this is actually very important. So I'll give myself an example. So when I was starting my career, I put my spouse as my primary beneficiary, and then I put my kids as the contingent beneficiary. I put them equally 50-50 because they're young kids and they're not adults yet. So I said, okay, half goes to one child and half goes to the other in case something happens to both myself and my spouse, right? And obviously there will be a trustee when they're younger. But as you age and people are now in their 50s and 60s, their kids are grown. So a lot of people still have their accounts as 50-50 between their kids, spouse, and then 50-50. But what happens, for example, if one of their kids is a doctor in New York and the other child is a school teacher in Florida? So if you leave your IRA as a contingent and you pass over to your spouse and they pass away, then the IRA will get split evenly between the doctor in New York and the school teacher in Florida. Well, the doctor in New York will probably be one of the highest tax brackets, potentially the highest tax bracket, plus state income taxes. So they might reach between state and local taxes. There's also local taxes in New York. They might reach up to 50%. So that IRA that they would have to take out, distribution, could be taxed at 50%. Well, let's say hypothetically that the school teacher in Florida might be in the lowest tax bracket. And so they essentially would be taking out money while one person's in the 50% bracket and the teacher will be in the lowest bracket. So the divergence will be quite substantial. So instead, something that advisor could look at instead would be potentially looking at contingency planning for their beneficiaries, maybe tax-free assets like life insurance proceeds or tax-free. Maybe they look at that, or step-up basis assets. It doesn't look like the step-up basis will be eliminated. So if they have non-qualified step-up basis assets, they might want to consider transferring those and naming those for their doctor child, because they're in the highest tax bracket. So they would enjoy the step-up basis and life insurance proceeds, which has no federal tax. And then you could give the taxable income to the child in Florida because they don't pay, they're in a much lower tax bracket. And then you could equalize the estate by giving the child in Florida just more assets because to compensate them for the fact that they, for the tax portion, because they might have to pay taxes even at the lowest bracket. So the net effect is that you would maximize your overall estate. You would maximize overall between your two contingent beneficiaries, the amount that each child receives and the amount that they would receive in total as well. So that's something that a lot of people don't think about when they look at estate planning. They think estate planning is all about estate taxes, or when they think about income taxes in distribution phase, because they think, well, what am I going to pay when I take money out to live on? But something that you want to think about also is income taxes as it regards to legacy planning, because it can be quite substantial, especially if you have a $400,000 or $500,000 IRA or higher. The difference between a tax bracket could be thousands of dollars that you would otherwise probably like to leave it to the kids rather than pay taxes on it to the federal government.
And a couple things to add, Jeng. One, practically, when we're setting up an estate plan, so for example, obviously I leave everything to my spouse right now, but we also have a 2-year-old son. And our 2-year-old son is not named as the contingent beneficiary on any of our accounts. Instead, there is a testamentary trust in his benefit that's named as the contingent beneficiary. Because he would, if something was to happen to both of us, he'd be a minor, doesn't have capacity to inherit funds. But in addition to that is the testamentary trust is not dissolved when he's 18 and he would have access to the funds. In fact, it's set up where he would get some funds at age 25, some more at 30, and some more at age 35. So that's where the importance of working with estate planning attorneys comes in, to set up an estate plan where assets can be predictably and responsibly distributed, especially to younger family members. And then another thing to consider from a tax standpoint is we have to remember that the stretch IRA option was eliminated 2 years ago. So for just about, for the majority of beneficiaries of IRAs, with the exception of spouses and disabled and chronically ill and minor children. So anyone who's, if you're an adult child as named as a beneficiary on your parent's IRA, you no longer have the ability to take a stretch distribution over the course of the beneficiary's life expectancy. So this can have a significant tax impact, especially if that beneficiary is in their high earning years. They're a high earner, like a doctor or a lawyer or an engineer or some profession like that. And they're forced to take either a lump sum or large distributions over the course of 10 years, because those are now the only two options they have. So there are several different options, several new or different ways to try to mitigate that. We don't have, that's probably outside the scope of this conversation, but using charitable remainder trust, using split beneficiaries, using a wealth replacement strategy, annuitizing death benefits if an IRA is held in an annuity. Those are ways to try to mitigate some of the tax burden that was caused by the elimination of the stretch IRA.
So one more topic I want to broach is you mentioned trusts, you mentioned annuities, the use of annuities inside trusts. Talk about that.
Sure. So irrevocable trusts are trusts that are utilized for estate planning purposes. So they're utilized to control estates and allow for assets to pass from one generation to the next, and potentially the next, and potentially the next, and the one after that, estate tax-free. Now, the drawback of irrevocable trusts, and there are many types of irrevocable trusts, everything from ILITs to credit shelter trust to dynasty trust to special needs trust. The drawback to these are they are very income tax inefficient. And what we mean by that is it only takes about $13,000 in income inside of an irrevocable trust to be triggering the highest marginal tax rate. So that means 35 or 37% at the federal rate, any state income tax, and we mentioned before the 3.8% net investment income surtax on capital gains. And irrevocable trusts by nature lend themselves to more high net worth individuals. So these are trusts that are going to have typically more a higher amount of assets in them. So it takes very little in investment returns to trigger those highest marginal rates. And if you're in a high tax state like California, New York, or Minnesota, you could be pushing pretty quickly up to 50% in the marginal tax rate there. So that's where a tax efficient vehicle like an annuity can come into play. By placing assets into the tax deferred wrapper of the annuity, you can avoid the year over year tax drag that's caused by those onerous trust tax rates.
So we've covered a lot of ground. Anything that you haven't mentioned but would like to, or anything that you've already mentioned that you might want to reemphasize?
Again, taxes are, like we said at the top, taxes are the biggest fee that most of us are going to face in our financial lifetime. And tax planning, especially now with tax changes and the potential tax increases that many of our clients will be facing, tax planning right now is more critical than ever.
One thing I'll mention real quick too is for those folks who are watching the legislative actions, is to look for the SALT deduction. I'll mention that real quick. It's something that we haven't hit upon. One of the proposals is to increase the SALT deduction from $10,000 currently to $80,000. Now, one of the myths is that SALT deduction only benefits people in the highest income tax states like New York or California or New Jersey. But it actually impacts quite a few people because the majority of states actually have a state income tax, even if it's 5, 6, 7%. So I'll give you a quick example. Let's say you have a client who's a high income earner and they make $500,000 and their state income tax is 5%. That means they pay $25,000 in state income tax. And let's say they live in a very nice house and they pay $10,000 in property taxes. So now you get to $35,000. So that's $25,000 more than they previously would have allowed under the current SALT deduction situation. Now, obviously, it hasn't passed, but now let's say they have $25,000 additional, and then now perhaps they didn't previously itemize because of the SALT caps. Now they will itemize. So now you have, in addition to $35,000, you have mortgage interest and you have charitable deductions. This could save a person in a high income bracket, even if they're in a low tax state of, let's say, 5 to 6%, of 10, 15, perhaps even $20,000, depending on how much property taxes they have, what their state income taxes, what their earnings are. Even if you live in a state with no income taxes, but you have high property taxes. For example, some parts of Texas has high property taxes. Those high property taxes might make the SALT deduction above what it was at $10,000. They might have property taxes that exceed $10,000. Parts of Florida, if you have a very nice house on the water in Florida, you might be above $10,000 in property taxes alone. So the reason I bring this up is because under the legislative proposals, one thing that also is sort of a minor point is that the alternative minimum tax, the Tax Cuts and Jobs Act, pretty much muted the alternative minimum tax. And so one of the proposals, or none of the proposals I've seen, is bringing back the personal alternative minimum tax, the individual alternative tax, corporate maybe. So if you combine the fact that the alternative minimum tax may not be around till 2026 because it might sunset, and the fact that they might increase the SALT deductions, it might be quite substantial. You might have people who save between $5,000, $10,000, $15,000, or $20,000 in taxes, just from the combination of raising the SALT limit, but not bringing back the alternative minimum tax provisions. And the key with that is the phase-out exemption. So that was the critical component on why a lot of people, there used to be about 5 million people who paid alternative minimum tax, and now there's about 200,000 people because of the phase-out on the exemption amount. So something to keep in mind, that if they do lift the SALT deduction and they don't put a provision in with the alternative minimum tax or the piece limitations, then your clients could potentially be saving thousands and thousands of dollars on taxes. And I want to sort of end with, nothing that we say constitutes tax, legal, or financial advice. Please consult your financial and tax professional.
Fair enough. Brendan, Jeng, I want to thank you for sharing your knowledge and wisdom with our listeners today. It's been a really insightful look into the world of taxes and why it's so important for advisors to become knowledgeable about such things. Thank you.
Thank you.
Appreciate it.
Thank you for listening to our podcast today. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org. For more information on Delaware Life, visit www.delawarelife.com.